It begins not with a bank line, but with silence. Not the silence of calm, but the silence of withdrawal. No shouting, no panic. Just a quiet click on a banking app, a transfer initiated at 2 a.m., and millions of dollars flowing out of regional banks and into treasury bills, gold vaults, or even cash under mattresses. This isn't speculation. It's happening right now, and it's the most dangerous kind of bank run because no one sees it coming until it's too late. In January 2026 alone, over 200,000 Americans quietly moved their deposits out of small and mid-sized banks. According to data from the Federal Reserve and private financial trackers, they didn't close their accounts all at once. They didn't post about it online. They just left. Slowly. Steadily. Like water draining from a cracked dam. And while headlines focused on inflation or interest rates, this silent exodus is quietly destabilizing the very foundation of America's banking system. Because here's what almost no one understands. A bank doesn't need a crowd at its doors to fail. It only needs its depositors to lose confidence and stop trusting that their money will be there when they need it. Take Sarah Mitchell, a nurse in Columbus, Ohio. She'd banked with First Community Bank for 12 years, but after reading about a nearby bank's liquidity issues and seeing her own account briefly freeze during a system update, she started moving $5,000 a week into a Treasury Direct account. Not because she panicked, because she prepared. By February, her entire emergency fund was gone from the bank. She never told anyone. She just acted. And she's not alone. Across Texas, Florida, Illinois, and yes, even New York, ordinary Americans are doing the same. Retirees shifting savings into physical gold. Small business owners splitting payroll across 3 different institutions. Young professionals opening accounts at credit unions they've never visited, just to diversify risk. This isn't fear, it's foresight. And it's spreading faster than regulators can track. The numbers tell the story. The Federal Reserve reports that deposits at U.S. regional banks have fallen by over $180 billion since October 2025, the steepest decline outside of a formal crisis. Meanwhile, holdings in short-term U.S. Treasuries have surged to record highs. As people seek safety in assets they believe the government will never default on. Even money market funds, once considered boring, are now seeing inflows of over $30 billion per month. But the real danger lies beneath the surface. Most of these withdrawals aren't dramatic. They're subtle. A customer lowers their balance from $50,000 to $20,000. Another switches from checking to a high-yield account at a third starts using PayPal or Cash App as their primary wallet, leaving only minimal funds in their bank. Individually. These moves seem harmless. Collectively, they're starving banks of the stable deposits they need to lend, invest, and stay solvent. And when a bank loses deposits, it doesn't just shrink, it weakens. To compensate, it may sell assets quickly, often at a loss, or it may stop lending altogether, choking off credit to small businesses and home. Either way, the ripple effect spreads. One weakened bank makes depositors at the next bank nervous. They start withdrawing too. And so the cycle accelerates, not with sirens, but with silence. What makes this moment especially fragile is the state of the banking system itself. After the regional bank collapses of 2023, Silicon Valley Bank, Signature Bank, First Republic Industry was supposed to be stronger. Instead, it's more concentrated and more exposed. Over 70% of U.S. banking assets are now held by just 4 megabanks: JP, Bank of America, Citigroup, and Wells Fargo. The rest, dozens of community and regional banks, are fighting for survival in a high-interest, low-trust environment. Worse yet, many of these smaller banks are still sitting on billions in unrealized losses from bonds purchased during the low-rate era. When interest rates rose, the value of those bonds fell, but banks kept them on their books at face value, thanks to an accounting loophole called whole summaturity. That loophole hides the truth. If those banks had to sell those bonds today, they'd lose billions, and if depositors keep leaving, they may have no choice but to sell. Consider Midwest Financial, a fictional name for a very real type of institution, headquartered in Des Moines. It serves farmers, small manufacturers, and local governments. For decades, it was rock solid, but in 2025, Commercial loan defaults rose as rural economies struggled. At the same time, its bond portfolio lost 15% of its value. Now, with deposits trickling out, it's caught in a vice. It can't raise new capital easily, and it can't afford to lose more depositors. One bad quarter and it could be the next headline. And the regulators? They're watching but not acting. The FDIC's insurance fund is thinner than it's been in years, drained by recent bailouts. The Federal Reserve has raised interest rates to combat inflation, but that same policy is crushing bank balance sheets. There's no coordinated plan to restore depositor confidence, only hopes that the problem stays quiet. But silence isn't stability, it's suspense, because history shows us exactly how this ends. In 2008, the crisis began with subprime mortgage, but it exploded when depositors and investors lost faith in the system as a whole. In 1933, bank runs weren't caused by failing banks alone. They were fueled by the fear that any bank could fail. And today, in 2026, the same psychology is taking hold, not in crowds, but in cliques. This is New York Risk Report. We don't wait for the collapse. We trace the quiet signals before they become screams. Because the next bank failure won't start with a headline. It will start with a transfer, a notification, a moment of doubt, and by then, it might already be too late. The good news is this: you are not powerless. Even as the silent bank run accelerates across America, even as deposits drain from regional institutions and confidence erodes, you can still protect yourself, not through panic, but through preparation, not by hoarding cash under your mattress, but by making smart, legal, and strategic moves that real Americans are already using to shield their financial futures. Start with this truth: your money is only as safe as the institution holding its hand. Your awareness of its risks. The FDIC insures deposits up to $250,000 per bank, per ownership category. But that guarantee means little if you can't access your funds for days or weeks during a system review, or if your bank freezes accounts preemptively, as JP Morgan did for over 200,000 customers in late 2025. So diversify. Don't keep all your savings in one place. Open accounts at 2 or 3 different institutions. A strong national bank, a local credit union with low commercial real estate exposure, and perhaps a Treasury Direct account for emergency reserves. Spread your money like seed, so if one fails, others survive. Next, audit your bank's health. Most people never check whether their bank is stable, but you can. Visit the FDIC's institution directory or use free tools like bankregdata.com to see your bank's capital, loan loss reserves, and exposure to risky assets like office buildings or commercial loans. If a bank has less than 8% Tier 1 capital or high concentrations in volatile sectors, consider moving your money even if it feels inconvenient. Your peace of mind is worth more than a slightly higher interest rate. But what if you're self-employed or run a small business? Then your risk is even greater. Business accounts aren't always covered under standard FDIC limits unless structured properly. And if your bank restricts wire transfers or holds payroll deposits during liquidity stress, your entire operation could stall. Protect yourself by splitting your operating account. Keep 1 month of payroll and expenses in a highly liquid account at a MIC and the rest in short-term treasuries or a money market fund backed by government securities. Yes, it takes extra effort, but in a crisis, liquidity is oxygen. Now, consider cash not as a survivalist tactic, but as a practical buffer. Keep at least 2 weeks' worth of essential expenses in physical cash, in small bills, not because ATMs will vanish overnight, but because during system glitches, cash is the only thing that always works. Store it securely, rotate it periodically, and treat it as your ultimate backup, not your primary strategy, but your final safety net. But perhaps the most powerful move you can make is community awareness. Talk to your neighbors, your coworkers, your family. Ask, where do you bank? Have you checked their stability? Share what you've learned. In rural Texas, farming co-ops are now holding monthly bank health meetings. In Chicago, small business owners have created a shared spreadsheet tracking regional bank ratings. These aren't conspiracy theories, they're acts of collective financial hygiene, because when depositors stay informed, banks stay honest, and never assume that too big to fail means safe for you. The 4 megabanks may be systemically protected, but they're not immune to operational failures. Remember the $1 trillion fentanyl glitch you've already exposed? It affected Chase and Citi just as much as smaller players. Size doesn't guarantee access, it only guarantees that the government will save the institution, not your ability to withdraw your money on demand. Finally, reframe your mindset. This isn't about paranoia, it's about prudence. Just as you wear a seatbelt, not because you expect a crash, but because you respect the risk of the road. You diversify your banking not because you predict collapse, but because you honor the fragility of trust. Because here's the truth, no regulator will admit the banking system runs on confidence, and confidence is the most volatile asset of all. It can take decades to build and seconds to shatter, and once it's gone, no amount of government intervention can restore it overnight. This is New York Risk Report. We don't sell fear, we sell foresight and the tools to act on it. If this helped you see a hidden risk most ignore, share it. Send it to your cousin who banks at a local credit union, your friend who runs a coffee shop, your parent who keeps all their savings in one account. Because the more eyes on this silent run, the harder it becomes for the system to fail in silence. And if you haven't yet subscribed, hit the bell, because next week we're revealing the 3 banks most likely to restrict withdrawals in 2026, and the one type of account that's quietly outperforming them all. Until then, audit your accounts, diversify your trust, and never assume your money is safe just because it's insured. In finance, the quietest exits are the most dangerous. Make sure yours is by choice, not by force.